guys, Brian Stevens with Mortgage Shots. Listen, today we have Jeremy Baggot. He's a real estate appraiser. He's an MAI and an AIGRS appraiser. He's also an author, and he puts out a fantastic press release on a weekly basis, and what he's looking at is waste, fraud, and abuse. And like I just told Jeremy, business is always good. The link to his press release is here, and I highly encourage everybody in real estate and lending to read it. There's great information, and I got to tell you, Jeremy, I love your writing style. It's easy to read, it's comprehensive, and it has a nice flow to it, and you're covering topics that really kind of get me riled up a little bit, and I want to go over one of them with you specifically today. But before I get there, here's one thing that I've looked at. I just want to get an appraiser's opinion of this. When we had our meltdown in 2008, it kind of went like this. Our inventory, we had massive inventory back then. It was kind of the opposite of what we have now. We had massive inventory and the prices dropped, and they dropped precipitously between 2008 and 2009. It just fell off a cliff. Today we have something that looks very similar, and now we see our transactions going down, but our prices have maintained at a high level, whereas in every other market you would expect them to drop like they did back in 2008. The one fundamental difference I've seen between 2008 and 2025 is the consumer reliance on Zillow. Now, Zillow has become the authority. Everybody goes to Zillow. And if Zillow is telling you that your property is worth 20% more than what you can get for it on a consistent basis, that would explain why we're not seeing prices drop off, and that would explain why we're seeing more properties coming off the market and not getting relisted more so than we've seen in the past. Is this completely off base from your appraiser's opinion, or do you think there might be something to it?
No, Brian, I think just look at the track record for Zillow. About a year and a half ago, it received, and its investors received quite a slap in the face when it was discovered that their division that was buying homes, they essentially put their money where their mouth was, and they started buying homes based on I'm assuming, something similar to the consumer version of the Zestimate.
Yeah.
And they started buying homes figuring, hey, we're going to use our algorithms to direct us into which homes to buy and which homes there's headroom to then resell at a profit. And this they did. And kudos to them for putting their money where their mouth was. But they learned very quickly that while this estimate may be accurate within a certain percentage point, it clearly wasn't accurate enough to make this sector profitable. And I'm fairly certain their investors took quite a haircut as a result of this, and significant market capitalization was lost. Maybe I seem to remember seeing that $1 billion in market capitalization that was erased as a result of them announcing that their estimate wasn't all they thought it was.
Yeah, Bill Akerman actually shorted them when he heard the then CEO, I believe it was Spencer Raskoff, came out and was talking about how the United States housing market was much more similar and had a unilateral approach than most people would think. And when he heard that, he said, boy, they're in for a rude awakening here. He wasn't taking the differences in communities into consideration. Yeah, and I think they lost somewhere to the tune of about 70% of their value cap at the time.
Right. I don't know that it was the differences in communities. I think it might have been more of the differences, and there's so many homes that have deferred maintenance. And if you take what the home would be worth without the deferred maintenance, just that alone. If appraisers did nothing other than go onto the property and pinpoint deferred maintenance, say, hey, the property would be worth X, but if you cure this deferred maintenance, it'll be worth Y. And that difference, I think, played a huge role in you can much more easily value a universe of properties of a certain type or properties within a certain school district, but it's very difficult to then drill down to the individual property level and go, wow, this property has some serious deferred maintenance. That needs to be cleared up if it's to reach this level that the algorithms had spit out. But of course, the algorithms are also not 100% accurate either. And it goes really back to a little bit of hubris to think that an algorithm could be designed to mimic the market. With every house that's, let's say, or any kind of property, commercial property, residential property, land. There are a lot of people that will look at that property and decide not even to provide an offer on that property, or not to look at it again. And so that in and of itself is a little mini transaction when a potential buyer looks at a property or looks at a listing or drives by a property and then decides to take the matter no further. It's there may be millions of those that are just kind of off the radar, but they're part of that, Adam Smith invisible hand. They're part of the magic of the market. And to think that, remember, Pentagon planners in the 1960s started feeding punch cards into computers in the basement of the Pentagon, trying to have the computer spit out when the Vietnam War would end. They put in all the variables that they could think of that would affect the Vietnam War, and so this is maybe urban legend, but they after feeding in the last 3,000 punch cards into the IBM mainframes, they left for the weekend. And they came home. They came back to work on Monday, and the computer spit out this was in 1967, and the computer spit out a readout that said the Vietnam War, it believes, will end in 1966. So, I mean, this is a good example of, and it's also, you could also say it ties into why the Soviet Union crumbled. When you have these 5-year economic plans, and every facet of the Soviet economy is supposedly accounted for, and you would just see tremendous gluts of things and tremendous shortages of things, and it's pure hubris to think that. Remember, Fitch, Standard & Poor, and what's the third one? Fitch, Standard, Moody's. All had their proprietary valuation models to value mortgage-backed securities and collateral debt obligations and synthetic debt obligations, all kinds of exotic products that then they were essentially taking junk rated securities and then spitting out investment grade ratings. And then there was one day, it was in 2000, I believe it was in July 2007, when I believe it was Standard & Poor's was the first to update. They used I can't think of the word that was used, but to update their ratings essentially. And they took maybe 1,000 or 3,000 mortgage-backed securities that were re-rated, and they went from AAA down to junk grade. And I think that was maybe the opening salvo, really in earnest, to the great financial crisis.
As John Cougar Mellencamp would say, that's when the walls came crumbling down.
Oh my God, yes. It was only downhill from that point until maybe the end of 2008, when things started when things had reached rock bottom.
But to your point, especially with what took place in the Soviet Union with the Vietnam War, we've seen a lot of that in the real estate space. We just spoke about it with Zillow, but as we sit here today, they've sat back and regrouped because they're heavily capitalized. And the idea that we can have an arrogant level of reliance on technology, as we sit here today, you look at the open doors and the OfferPads of the world, and their stocks are getting kicked around again. How long is this going to go? I don't know. What I really want to talk to you about today, and feel free to correct me in anything I say, but I've talked about this where overnight, and guys, we're going to talk about some stuff that you might find sensitive, and I really don't want you to look at that from that perspective. If you have any comments on this, just keep them respectful, and you can absolutely disagree with us, because we can use examples that don't necessarily take race into consideration, and it's very, very similar. But from my perspective, it seemed like overnight, the appraisal community all decided that they were going to frankly become a little bit racist when it came to their valuations. And these stories were cropping up left and right. And it happened to be at the very same time that Fannie Mae and Freddie Mac were rolling out and pushing an automated alternative to an actual real estate appraiser. And I'm looking at these 2 points and I said, boy, isn't this convenient timing? Now, to give you a little bit of back history to this, we passed something called HVCC. It was the Home Valuation Code of Conduct, and it led to the proliferation of AMCs that everybody's familiar with today. And that was a bad idea then. Frankly, I believe it to be a bad idea now. It led to geographical general incompetence, appraisers going to areas that they weren't familiar with, and the appraisal community, by and large, decided we don't want to do this, our fees have been cut, and we are going to get out of the industry. No other appraisers were getting into the industry at the time because becoming an appraiser is actually a very, very long-winded process. If you want to become an appraiser, it's not going and, reading a couple manuals and taking a test. You have an apprenticeship that, at the time, I believe it was over a year. I mean, it was definitely a craft. This created a problem, but rather than roll back the problem, we just added to it. And that's where we kind of came up with this whole idea of an alternative to a real estate appraiser, and that was bringing in these valuation models. But in order to do that, it seems to me it's a pretty good idea if you can smear the alternative in the process. So when I saw these stories cropping up left and right, and they all had a very similar theme, and I really have to tell you, Jeremy, you outlined this really, really well, and I think it's fairly transparent. There was a gentleman, his name was Nathan Connolly, and he was a professor over at Johns Hopkins, and he decided he was going to get an appraisal on his house. Nothing wrong with that. But Nathan Connolly, he wrote a book called A World More Concrete, Real Estate, and the Remaking of Jim Crow, South Florida. He also has a number of different designations that are going to run along a very similar vein. And there's nothing necessarily wrong with that either. However, if you only have a hammer, you tend to think all your problems are solved with nails, meaning we have the tools at our disposal to do it. So if we're going to try to find problems with race in an appraisal, this would be the perfect candidate. Now, if you can you kind of outline what the story is? And we ultimately get to the FHFA that I want to speak to you about. But would you, for our viewers, outline how this story went?
Well, I've been sitting watching this for since at least a couple of years, and it's not just this case, but there was almost what felt like a stage managed rollout of cases,
right?
And also a media campaign, and really, since maybe George Floyd, there's been a proliferation of reporters at different daily newspapers and online sites that used to be newspapers that are called the racial. The name of their beat varies, but it's something like the equity beat or the racial diversity beat. So their publications were tasking reporters with looking for signs of inequality in our society. And so it was very good timing that they were able, it felt like a rollout of frivolous lawsuits by disgruntled borrowers. Remember, our job is to render an opinion of value. We're the eyes and ears of banks, of non-bank lenders, of accountants. We're engaged uniquely to be disinterested third parties. As I told you earlier, off camera, in many cases, if an appraiser is consistently making one side happy over the other, or consistently overjoying his client, that is a sign. That is I think a sign that maybe the appraiser needs to rethink what he's doing. Similar to a music agent who representing an artist who is becoming too friendly with the record labels. Right? It's coming at the expense of his client. Appraisers have to walk a fine line, and we don't. I do right now. I'm doing mostly right-of-way work, and so I'm being engaged to render opinions of values of different types of rights, of easements that are being sought by public agencies, or in some cases, full fee takings of a property. It's fairly rare, but occasionally a public entity will pinpoint a property that they need to put a sewage pump station on that property, and it's going to mean that they need the whole thing, and they bring me in to render an opinion of value. And on one hand, we want to do right by the property owner, and in the state of California, we appraise to the highest value the property would achieve based on some different caveats, cash or cash equivalents, an equally knowledgeable buyer and seller, but it's the highest value. And but on the other hand, we can't be dispensing gifts of public funds. So, if we've done our job right in the right-of-way world, probably both sides are not going to be fully happy. The government agency may end up paying a little bit more than it had budgeted for, and the property owner might be a little bit worried that he didn't hold out long enough, or he didn't drive a hard enough bargain. But it's the same thing with doing work for residential lending. And I have done work for residential lending.
But specifically as it pertains to Nathan Connolly here, that I believe the valuation that was given was, I want to say $550,000. What immediately caught me as crazy, and you outlined it in your article, court records show that over a 2.5-year period, the law firm Relman Colfax, they billed 5,411 hours at an average rate of $583 per hour, with the total expenditures reaching $3.15 million. In other words, the thinking is for this professor, a highly educated individual who disagrees with his $550,000 appraisal, he was willing to pony up $3.15 million to protect $550,000. That right there seems a little problematic, don't you think?
Well, I would go one further. I would say he was willing to somebody was willing to pony up, or at least put at risk, $3.15 million over about a $25,000 discrepancy. The home was purchased in 2017 for, I'm not looking at the number, but I believe it was $450,000. And his appraisal on here, again, I'm not looking at the number, but I believe it came in at $474,000 or something like that. So maybe a $24,000 difference, and some loan terms that probably the guy could have gone down the street if he was absolutely convinced that his home was not worth something similar to what he paid for it in 2017, and then presumably an arm's length transaction. If he believed that it was worth in the 700s based on some work he did on the property, then he certainly could have just gone and reapplied somewhere else. Appraisers are used to being called all kinds of bad names and being treated kind of in a brutal manner sometimes. But when based on a hunch that the reason that that I disagree with the value that the appraiser reached was because the appraiser is a racist, or the appraiser is a bigot, and somehow that bigotry, that I believe based on a hunch that appraiser was somehow acting out of racial animus, that appraiser then somehow skewed my value down to something that is below what it is actually worth. Now, as you mentioned, the professor, he's a professor at Johns Hopkins, focuses on, in the generic term, Black studies, and on racial injustice, on Jim Crow law, he has a 33-page resume of which in and of itself something of a manifesto of all of his writing. And just reading the titles, you can see, okay, this, and I've actually clicked on the links to read some of the articles that he's authored, and I can tell you he is preoccupied with race, real estate. I mean, this professor is, let's put it this way, if this professor is successful in his lawsuit, it will be the vindication of all of his life's work, basically. And I guess he has every right to do that. He has every right to do it. But then the public has every right to look at what's going on here and comment on this entire episode.
Oh, we certainly do. And again, when you put $315 million up to fight, $500,000 appraisal as being brought in lower than it should be based on the ethnicity of the person living in the house, that makes you really kind of think about this. So the question then becomes, where did the money come from? And you wrote that Senator Tim Scott, chairman of the Senate Committee on Banking, Housing, and Urban Affairs, accused Freddie Mac and Fannie Mae, the regulators, and this is at the time last month, of colluding with the mortgage giants to engage in illegal activity. In other words, the accusation...
Well, hold on. I quoted Senator Scott, and I don't think his quote was exactly that. I think he was accusing the FHFA, Freddie and Fannie's regulator, of illegal activities.
Correct. And here's Scott's quote is, in just a few short years, FHFA went from an agency carefully considering how to preserve and protect the safety and soundness of the failed enterprises to a politicized husk reacting to the whims of the administration and completely disregarding the law. So the belief is that the FHFA, who hold Fannie Mae and Freddie Mac in conservatorship, who have frankly, they have a job to stabilize the GSEs and get them out of conservatorship as quick as possible. That's the idea of conservatorship. Have now held Fannie Mae and Freddie Mac in conservatorship longer than any entity or person in the history of this country. That's a true statement. Beating out Britney Spears, might I say, which is kind of a great trivia point. They've been held in conservatorship for years and years and years. And I think what Scott was suggesting here is they've turned into a political arm of an administration being the champion of sorts to certain agendas, this being one of them. If Fannie Mae and Freddie Mac are rolling out an alternative to real estate appraisers, it's alleged that the FHFA was then not fulfilling their fiduciary as a conservator, and they were funneling some of their money towards the law firm that was fighting on behalf of Nathan Connolly. Is that correct?
It's unknown. It's unknown where it's unknown. It's just open to speculation. I talked to Brian Gerard, a former subject matter expert at Fannie Mae's collateral valuation function. Okay. He's no longer an employee, and he believes that it may have been a diverted HUD grant. Remember, after the COVID Relief Act and the Infrastructure Act and the Inflation Reduction Act, there was a COVID Supplemental Act, trillions of dollars, where a wall of money was pushed onto these cabinet level agencies, and HUD reigns over budgetary resources of over $200 billion. It was like $214 billion, and they don't have. I think probably I was looking recently at the Federal Highway Administration. They have 3,000 employees, and they too, especially after the Infrastructure Act, suddenly was, I guess it's a luxurious problem, but they had too much money that they could, and they weren't able to oversee grants that they were making, so they're pushing that unlawfully onto the states to do federal oversight of some of this money. But I'm sure the same thing happened with HUD, is this money just rained down on that, cabinet level department, and they weren't able to properly oversee it. And I suspect that, you look at some investigations like the one of an appraiser named Ken Mullenix, and what he describes sounds like it's something out of a Kafka novel. But they have, let's put it this way, they are not hurting for money. And I believe that money has gone toward creating a good deal of mischief. It's not just the money is being wasted. The money is actually being put to use for malign purposes in some cases, or maybe through incompetence. What's happening is it's creating perverse incentives in the markets. Probably in the best scenario, it's only creating perverse incentives and in the markets. But in the worst scenario, it's being used for malicious purposes. And I think when it comes to this campaign against appraisers, these nonprofits that have received grants from HUD, government contractors that are being hired by HUD as discrimination testers, HUD did a notice and comment rulemaking last year on which they wanted to break from a previous protocol where they would not grant funds to nonprofits that employed convicted felons. They wanted to reverse that. So then, but don't worry, it was only things like perjurers and white collar criminals, embezzlers. It wouldn't be it wouldn't be violent felons. So, but those are just the kind of people that have been someone like Ken Mullenix describes. He feels like he's being the full weight and capability of the U.S. federal government is being used to investigate him in a very similar case where he simply concluded at a value that did not satisfy what was required to make a refinance pencil, and that alone drew a HUD complaint by an appraiser who had already complained to the VA. The VA spent a year investigating Mullenix, and they found no evidence that he had acted in any way other than correctly as an appraiser. property owner then took that complaint, put it in an envelope, and sent it to HUD. And then HUD has been investigating him. He's essentially turned into a full-time professional defendant with this HUD investigation. And from his description, it sounds like they, anything but that they are hurting for funding. To at least with his, there may be as many as 1,000 appraisers, according to his research, that are in the same boat as he, with HUD encouraging complaints, putting posters in airports around the country, media buys in publications and things like that to try to motivate homeowners who simply an appraisal concluded at a value that torpedoed a deal, that didn't allow. In some cases, these are property owners that have been put into debt traps. Many times they're refinances as opposed to sales. But either way, it should be alarming, because if appraisers are being intimidated in appraisals of properties for sales, those comparables are going to be floating around and used by other appraisers who maybe aren't feeling intimidated, who will use those as bona fide sales, not taking into consideration that, wow, this high sale may have been green lighted by an appraiser who was scared to death of a HUD investigation and just has decided, I'm going along with any value, that from now on the contract price is the value automatically.
So you see the concern here is that, I mean, frankly, it looks, smells, and quacks, excuse me for mixing my metaphors, like a conspiracy here. You wrote that Brian Gerard, who is a former subject matter expert in collateral valuations at Fannie Mae, so he's somebody who comes with a certain level of authority, speculated the money bankrolling Connolly's lawsuit was most likely diverted from money and grants from HUD. And you go on to say that Gerard quotes, and this is a quote from Gerard, HUD is the highest authority in the land when it comes to housing. But it's been, and we're seeing a lot of this right now in the news, but it's been unable to track the grant fund it has been handing out. Where did the plaintiff, a university professor, get $3 million to go after an appraiser? And when you look at HUD's mission statement, is to serve underserved communities. This has always kind of been in the purview of HUD as far as I can see. So you have a number of folks who would be, maybe not necessarily experts in the area, but they're walking alongside the folks. They are part of the inner group who kind of looks at these type of things. And I think what's being suggested here by Gerard, I don't know if it's your opinion, but they're saying, hey, listen, this is something that's happening from HUD. This is coming from HUD. And we see right now that money's being diverted. I did stories 15 years ago where the G fee from Fannie Mae and Freddie Mac, I don't know if it was before or after conservatorship, but they were using money that was earmarked for housing. The guarantee fee that's generated on every single Fannie Mae and Freddie Mac transaction was being earmarked for housing, was diverted to clean up the BP oil spill in the Gulf.
Brian, I could do you one better. The HUD has created something called the HUD Exchange, and they hijacked a website. They somehow got funding from the Veterans Administration, a website that was being used to help connect disabled veterans with medical resources. That became the HUD Exchange, which is now being used, or maybe until the recent purge of DEI activities, at least the last time I checked, about maybe 2 weeks ago, is still being used to connect plaintiffs, potential plaintiffs in these HUD property owners who feel they've been slighted on appraisals or what have you, with attorneys willing to file lawsuits in their favor. It's called the HUD Exchange. It's a clearinghouse of public and private materials that kind of gives any casual visitor to the site an idea of like, which attorneys do I need to contact to sue an appraiser for the only reason because the value failed to reach a certain dollar figure that would enable the transaction to close. In some cases, maybe the over time, the property owner decided he didn't like the shine of the appraiser's shoes or the cut of his jib or her jib or what have you. But that's kind of what's happening, is HUD has been either implicitly or explicitly, in the case of those airport posters and the media buy, explicitly encouraging people to report appraisers for simply doing their job. The appraisers have a very unique, as you know, have a very unique position in a real estate transaction. In many cases, we're the only ones in the room who are not. We don't make a commission. We don't get paid if the transaction closes. We get paid a flat fee, and in many cases, a pretty bad flat fee, and we do the work. And then sometimes we get beat up for it. Metaphorically speaking. But appraisers do have very thick skin. I would say like the kind of people who are attracted to appraising, other than the extremely desperate, would be people that I would say maybe would be attracted to being a ref, a hockey ref, or a soccer ref, or something like that. It's definitely not for everyone, and you have to know a lot of rules, and you have to be able to, you have to take a lot of abuse, but you grow a thick skin. But even having said that, when you call somebody a bigot, usually, from my own experience, people that I've known in my life that have been bigots, if you call them a bigot, they don't have a problem with that. Yeah, I'm a bigot. Yeah, that's what they say, right? Oftentimes, they think it's funny, or they don't get offended. But if it's a person that is not a bigot, that goes out of his way to be colorblind, that person, you call that person a bigot and say, hey, your life's work is based on bigotry. Oh, and by the way, this is subconscious bigotry. You can't even do anything about it.
Well, I think that's what makes this story, and this one doesn't stand alone. There's a number that have been filed very similar to this. It's a slandering of a person's profession. It's a slandering of a person's life work. And how the outline of this is that this wasn't necessarily about the value of the property. It was about taking down an industry because there was an alternative in the wings to replace them.
This
became very, very expedient. That's where the problem lies. But now what happens is somebody is slandered. Their profession is, their person is, and they have to pay the price for somebody else's agenda. Again, where did the $3.15 million come from? Ford said, and I believe Ford is part of an appraisers group, he said $3 million may be enough to crush an individual, which, by the way, check the box. They did it. He's a professional defendant, but it's a crumb when compared to the billions that were handed out by HUD to grantees with a long-term objective of eliminating human appraisers. Guys, this all came down at the same time. This was simultaneously dropped, and it was dropped as a means of correcting what they screwed up over the previous decade. That's what it came down to. Bad policy after bad policy after bad policy to try to correct the initial bad policy, which was HVCC. This is a problem that is almost 20 years in the making right now. And I want to be clear about this as well. The appraisal, when it was looked at, Nathan Connolly's appraisal, it came back and said there was nothing wrong with the work that the appraiser did on the property. But that is an afterthought to what the actual objective was. Our appraiser is smeared. The agenda of pushing alternatives to human being appraisers has been somewhat successful, and the industry and the viewing public, by and large, are going along with the narrative because we haven't seen what the bigger picture is. When we look at this story, I'm not knocking Nathan Connolly at all. Please don't. I'm not knocking him at all. I'm sure he's a wonderful professor. But if you wanted to push an agenda, you found the perfect individual with the perfect resume to do this with. Then when you give over $3 million to defend a $500,000 appraisal or thereabouts, where the money isn't clear where it came from, and simultaneously, and HUD, who has a long, rich history of, serving underserved communities, which is part of their mission statement, this tends, to make a lot of sense. Where there's smoke, there's fires. And there's been people inside the FHFA, Fannie and Freddie, and inside HUD, and inside different appraisal institutions who've been saying, well, if we want to find a culprit here, the most likely culprit is HUD. We're not saying that HUD did this, but like I said, we don't have the smoking gun per se, but there is a lot of evidence pointing in that direction. And it frankly is expedient for the cause that the GSEs, the FHFA, and HUD would have on a multitude of levels. Would that be a fair summary?
Yes. No, it very much feels to observers, to myself, and many appraisers. I would say almost every appraiser who's maybe not promoting some kind of hidden agenda, that yes, this feels like it's stage managed. It's a phase rollout of these lawsuits, of complaints, of then each one is answered by new regulatory crackdown that has eliminated the number of appraisals that, for example, Fannie and Freddie rely on. It's increased the loan-to-value ratios when appraisal is necessary. It's functioned as a kind of fig leaf as a pretext for the FHFA, Freddie and Fannie, HUD to then kind of crack down in a regulatory fashion and also make examples out of all you would need to do. In fact, I'm probably doing a pretty good job as what's the term the KGB uses, useful idiot. I'm helping HUD by promoting all of the abuses that I'm seeing at HUD and spotlighting people like Ken Mullinex. I'm probably helping the overall strategy of sidelining appraisers, scaring appraisers into never deviating from whatever they feel is required to make the sale or the refinance work. I'm sure there are appraisers who are just rubber stamping values. Maybe they're close to retirement. Maybe they don't want to deal with this. They would otherwise be honest and courageous appraisers, but seeing what happened, people like Ken Mullinex and others, they are, probably, I'm guessing, I have no basis for this, but I'm guessing it has cowed appraisers. And but they've also used this as a way to justify eliminating appraisals, waiving them.
Well, I'll tell you what, and it's taking a lot of wealth for a lot of honest, hardworking appraisers, individuals, and money that would go to our communities. And it's shifting those, what would be billions and billions of dollars through automated appraisals, alternatives to appraisers, and it's putting that back into the coffers of the government. And, I got to tell you, this is, from my perspective, this is a huge disservice, not just to our industry. Our industry really doesn't matter, but it's a big disservice to our clients in the communities that we all care for and we all represent. If you're a realtor, if you're a lender, or you're an appraiser, you're part of a community. And this does nobody a service, because these algorithms, which might be halfway decent today, we've seen this with the Open Doors, the OfferPads, the Zillows, where they all crashed within days of each other. We see, their value right now. It's all based on dependencies from algorithms that don't understand the fabric of our communities as well as individual appraisers. This is true through and through.
Actually, Phil Crawford, a podcaster who's kind of the father of this concept called data cancer. And it's essentially Fannie and Freddie use these internal algorithms, from the basement of, I don't know, I could just imagine, a bank of computers in the bowels of, their facility in Plano, Texas. And they're Fannie and Freddie and these technocrats. I don't doubt that they honestly and truly believe that the markets can be replicated using big data and using AI and heavy duty computing power. And I think what's happening is they're creating like an internal feedback loop. And as we saw with Fitch and Standard & Poor's and Moody's back in 2007 and the lead up to the great financial crisis, the feedback always seems to favor the values that are required to make things, on the whole, make transactions work. And that feeds into executive bonuses and commissions of individual salespeople, and they're and just like with Fitch, Standard & Poor's, and Moody's, their algorithms, their quantitative scientists seem to somehow create models that always favored velocity, transaction velocity, at the expense of the actual soundness of in that example, the mortgage-backed securities.
What these algorithms could never figure out, and we saw this, I'm not making a joke here, what they can never figure out is when Bobby gets foreclosed on his house, and by the way, foreclosures are up 300% over the past 4 months in Phoenix alone, and they are the canary in the coal mine. What these automated valuation systems cannot figure out, particularly in markets where we have foreclosures, which is probably coming, is when Bobby gets foreclosed on his house and if he feels like he's been wronged, and he decides to flush a bag of concrete down every single toilet on the way out the door, an automated valuation system can't figure that out. So whoever's going to buy that house unsuspectingly is gonna face themselves with a heap of problems. Listen, guys, if you'd like to read Jeremy's article, it is beautifully outlined, and if you'd like to get what he writes on a weekly basis on his press release, this was brought to me from my partner Joanna. Her father, who's a lifelong appraiser, sends it to her. It's good dad stuff to do, because that's what every dad does to his daughter, is sends her articles on appraisals. But we were fortunate enough to get this. If you'd like to get it, you can just click the link down below for Jeremy's press releases. And Jeremy, thank you so much for your time. This has been wonderful, and enlightening, and I just appreciate you bringing light to I think a topic that is frankly overlooked at this point. So thank you so much.
You're welcome. Thanks for having me.